Hi, I'm Jean, a researcher at The Expert, and today we'll be talking about Barclays' earnings and its internal reforms for an attempt for a growth revival. On February 20th, Barclays disclosed a net loss of £111 million, which is approximately $139.8 million for the fourth quarter as the British bank unveiled a comprehensive strategic restructuring, causing its shares to surge over 6% during early trading. Barclays' full-year ROTE, which stands for Return on Tangible Equity, was 10.6%, excluding its fourth quarter restructuring costs. As for its Q4 ROTE, it was down from 8.9% to 5.1% in the final quarter of 2022. Barclays is now targeting a ROTE of more than 10% this year, rising to over 12% in 2026. Capital distributions for the 3 years 2024, 2025, and 2026 are likely to total £10 billion, largely weighted towards share buybacks, which should provide some share price support. Along with Barclays' earnings release, the bank announced a huge operational overhaul, including substantial cost cuts, asset sales, and a reorganization of its business divisions, while promising to return £10 billion to shareholders between 2024 and 2026 through dividends and share buybacks. Also, the business will now be divided into 5 operating divisions, separating the corporate and investment bank to form Barclays UK, Barclays UK Corporate Bank, Barclays Private Bank and Wealth Management, Barclays Investment Bank, and Barclays US Consumer Bank. This resegmentation will offer improved and detailed disclosure of each operating division's performance, enhancing accountability from both operational and management perspectives. However, all this restructuring isn't something new. The bank announced its restructuring plan last October as part of a plan to improve profit margins. And what the bank's CEO Venkat is trying to achieve is a simpler, better, and more balanced bank. He revealed that this plan was designed to cut £2 billion in costs and return at least £10 billion to shareholders by 2026. So far, this new strategy has already cost the bank £927 million in structural cost action, including £340 million on staff, £227 million on office space, and £360 million on infrastructure. Considering Barclays' aim to regain profitability, doesn't Barclays' plan seem too good to be true? Despite its hopeful efforts, let's begin by examining its equity perspective. Barclays' price-to-book ratio standing at less than 0.4 times with a 20% implied cost capital ranks among the lowest compared to similar major European companies. This suggests doubts about its ability to reach its targeted profitability goal of over 12% by 2026, as projected by 2024 estimates. Besides, it's anticipated that Barclays' Corporate and Investment Banking (CIB) division will play a significant role in generating over half of its revenue in the coming years. This hinges on a potential recovery in deal-making driving fee growth alongside positive trading activities despite market volatility. Analysts predict a shift towards activities with lower capital requirements to improve return on equity. Projections suggest trading activities will make up 56% of CIB revenue by 2025, down from 66% in 2022, signaling potential for growth. Similarly, banking fees, especially those linked to debt capital markets, are expected to rise to 17% of total revenue. To sum everything up, Barclays' Q4 results showed mixed performance, with a weak final quarter offset by a promising strategic update. The groundwork has been laid for ambitious and profitable results in the next 3 years. While the realization of this optimism remains uncertain, Barclays' deep pockets and diversified business model are factors tipping the scales, resulting in a cautious buy consensus in the market. If you found this video insightful, please subscribe, share, and like it. Thanks for tuning in, and see you in the next one.